They'll catch up. You guys will catch up. Hey, I'd rather speak at this level,
right,
and push everybody up to that level than speak down here and let people be bored,
exactly.
So the way that I find deals is I find wholesale properties. I come from the residential realm.
Right.
Okay, so in residential, what's the equation that you use to go buy properties? You got to be all in for 65% of the after repair value.
Right.
Commonplace across single family. When I got into commercial and investing in apartment buildings, I realized that a lot of people would go and pay 100% for a building. And I'm like, why would you ever do that? And it just never made sense to me. So what I ended up doing was I just implemented the residential strategy into apartment buildings. So instead of being all into a building that's worth $10 million for $10 million, I'd be all in for 65% of the stabilized value. So I'm all in for $6.5 million on something that's worth $10 million. And then instead of selling it, what I do is I turn around and I refinance it. So I'll use an acquisition loan along with private money for the $6.5 million to buy and renovate the property. Then I go and I'll refinance it maybe at a 70% loan to value. So it'll give me $7 million on a $10 million valuation. Mm-hmm. Following me? Use that $7 million to pay off the $6.5 million I'm into it for. Take $500,000, put it in my pocket tax-free. All my investors have been paid back. They still maintain some equity in perpetuity in the deal. And at the same time, now we have a cash flowing asset, totally stable, that the tenants who are paying rent every single month cover the operating expenses, pay for the debt service, the mortgage, and put cash flow in our pocket for as long as we own this building. And it's only house money in play. It's only bank money in play. And it's a non-recourse loan on the back end, which means nobody has to personally guarantee it. The bank's only recourse against that loan is the property itself.
Now, your partners, the equity share people, are you sharing any of your cash out refi with them?
Yes.
Okay.
So if you got 20% of the deal, I have 40% of the deal, and somebody else has 40% of the deal, we take $500,000. You get 100, I get 200, this person gets 200.
Gotcha. Very cool.
Yeah, so everybody gets paid in everything that we do, and we align it in a way that we all make money with a common goal and a common vision. I don't make a dime. I actually, on a lot of my buildings, I pay for my entire team for a year until we hit the refi stage. We don't usually take acquisition fees. We don't take asset management fees. We only get paid when those refinance proceeds come off the table. But I think it's fair because that's when the investors get all their money back, right? So now we're both incentivized to get it to the finish line, get them their money back, then I get a big windfall of cash, and now nobody has any money at risk anymore, and we hold on to the property, and then we can roll into another deal, right?
What a great opportunity, though, for someone to cast out a couple $100,000 and then get it back in 18 months and still maintain ownership,
right,
with having nothing at risk now.
That's why it's really easy for us to raise capital, because and because we're holding on to the asset, it's very tax advantaged too, right? So you're not actually like we pay a fixed preferred return, so like a fixed interest rate while the money's invested, and at the same time, that's not taxable income to them like it would be if you had interest dividends from a stock, right? You had to pay that at your tax rate this year. Because we hold on the property, it's that's not a taxable event until we actually sell the property. So it could be 10 years down the road that you pay taxes on that, and at that time, it's actually only taxed at long-term capital gains, which is significantly less than what probably your earned income tax bracket is, right? So it's pretty cool how we structure that.
All right, now that we've scared everyone at home into thinking this is the most complicated business in the world.
It's not complicated.
No, it's not. Let's break this down. Very, very simple here. So you don't pay tax on borrowed money. So when you're refinancing money out, you're not paying taxes on it.
So it's like a single family home. You buy a $100,000 house in Parma, Ohio, and you own it free and clear. You go and put a bank loan on it. The bank gives you $80,000. It's not taxable money. You have to repay it. It's a loan. The difference is it's not you repaying the loan, it's your tenant repaying the loan. So you can take that $80,000 and borrow it at 4.5%, and as active investors, we can go and get better returns than 4.5%. So why wouldn't you take that money off the table using debt in a good way, right? Not in an irresponsible way, but in a very responsible way, and then utilizing it to go buy more assets that produce more cash flow.
Right. So you're taking this money at 4.5% and going out and making 10.5% with it. So you're making 6% yield spread, and you're making your money. So you're making money on money that's not even yours, really.
Right.